On October 22nd, 2024, at the BRICS summit in Kazan, Russia, something happened that received almost no coverage in Western media. Vladimir Putin stood before representatives of 36 nations, including China, India, Brazil, South Africa, Iran, Egypt, Ethiopia, and the UAE, and announced the launch of BRICS Pay, a cross-border payment system designed to bypass the US dollar entirely. The same week, Saudi Arabia confirmed it would accept Yuan for oil sales to China, marking the first time since 1974 that Saudi oil could be purchased without dollars. These aren't random events. They're coordinated moves in what economists are calling de-dollarization, the slow, deliberate shift away from the US dollar as the world's reserve currency. And the data confirms it's accelerating. According to the IMF's latest COFR data, currency composition of official foreign exchange reserves, the dollar's share of global central bank reserves has fallen from 71% in 1999 to 58% in Q3 2025. That's the lowest level in 30 years. But here's what makes this different from past currency transitions. For the first time since World War II, there's an organized coalition of nations representing 45% of global population and 37% of global GDP actively building alternatives to dollar-based systems. Disclaimer. This analysis examines currency reserve data, international trade patterns, and geopolitical developments. Currency markets and geopolitical outcomes are inherently unpredictable and depend on policy decisions, technological changes, and events that cannot be forecast. This is educational content, not investment or financial advice. Consult qualified professionals for personal decisions. Now, let's understand what de-dollarization actually means, and whether the dollar's dominance is genuinely under threat. The petrodollar system. To understand what's changing, you first need to understand what the petrodollar system is. In July 1974, following the oil crisis of 1973, the United States and Saudi Arabia struck a deal. Saudi Arabia agreed to price all oil sales in US dollars, invest surplus oil revenues in US Treasury bonds, maintain stable oil production. The United States agreed to provide military protection for Saudi Arabia, sell advanced weapons to the Saudis, support the House of Saud politically. This wasn't just a bilateral deal. Saudi Arabia convinced other OPEC members to follow the same model. By 1975, all OPEC oil was priced in dollars. Why did this matter? Because oil is the most traded commodity on Earth. Every country needs it. If oil is only sold in dollars, every country needs dollars. This created automatic demand for US currency. Countries had to hold dollar reserves to buy oil. Oil exporters accumulated dollars and invested them in US assets. The result? The US could run perpetual trade deficits without currency collapse. Foreign nations needed dollars, so they bought US bonds, which financed US government spending, which allowed the US to maintain global military presence, which enforced the system. It was a self-reinforcing cycle that gave the United States what economists call exorbitant privilege, the ability to print the world's reserve currency. For 50 years, this system was unshakable. Until now. The cracks in the system. The petrodollar didn't collapse overnight. It's eroding through 1,000 small cuts. Cut 1. The Russia sanctions, 2022. When Russia invaded Ukraine in February 2022, the United States and European allies imposed unprecedented financial sanctions. They froze $300 billion in Russian central bank reserves held in Western financial institutions. This sent shockwaves through every non-Western central bank. The message was clear. If you hold your reserves in dollars or euros, and you take action the West disapproves of, your reserves can be frozen or seized. China watched, India watched, Saudi Arabia watched, Brazil watched. And they all reached the same conclusion. Dollar reserves are not neutral assets. They're geopolitical leverage that can be weaponized. Cut 2. The Saudi-China oil deal, 2023-2024. In March 2023, Saudi Arabia and China announced that some oil sales would be settled in yuan rather than dollars. The percentage was small initially, less than 5%, but the precedent was historic. For the first time since 1974, the petrodollar monopoly was broken. By December 2024, Saudi-China oil trade settled in yuan had grown to an estimated 15-20% of total transactions, according to data from the Shanghai Petroleum and Natural Gas Exchange. Cut 3. BRICS expansion, 2024. On January 1st, 2024, BRICS officially expanded from 5 members to 10, adding Egypt, Ethiopia, Iran, Saudi Arabia, United Arab Emirates, note, Argentina declined membership after new government elected. Then in October 2024, at the Kazan summit, another 13 nations were granted partner country status, bringing the coalition to 36 nations. Combined, BRICS plus nations now represent 45% of global population, 3.6 billion people, 37% of global GDP, PPP adjusted, 43% of global oil production, 72% of rare earth element production. This isn't a marginal block. This is half the world by population and more than a third by economic output. Cut. 4. China's CIPS system, China's cross-border interbank payment system, CIPS, launched in 2015 but was little used initially. By 2025, CIPS processes over $13 trillion annually in international payments, up from $434 billion in 2017. It's not yet close to SWIFT's $150 trillion annual volume, but the trajectory is clear. BRICS Pay, announced in October 2024, is designed to integrate with CIPS and allow direct currency swaps between BRICS nations without dollar intermediation. Cut 5. Central bank gold. Buying central banks globally purchased 1,037 metric tons of gold in 2022, 1,081 tons in 2023, and 1,045 tons in 2024, the highest three-year buying spree on record. Who's buying? China, Russia, India, Turkey, Poland, Singapore, almost entirely non-Western central banks. Why? Gold is the ultimate neutral reserve asset. It can't be frozen. It can't be sanctioned. It can't be printed. As central banks reduce dollar reserves, they're not just buying euros or yen, they're buying gold. The data. Dollar reserve decline. Let's examine the hard numbers. According to the IMF's COFR database, dollar share of global reserves, 1999, 71.0%, 2010, 61.5%, 2020, 59.0%, Q3, 2025, 58.0%. That's a 13 percentage point decline over 26 years. But here's what matters. The decline is accelerating. From 1999 to 2015, the dollar lost about 0.5% per year. From 2015 to 2025, it's losing nearly 1% per year. What's replacing the dollar? Euro, 20.5%, up from 18%. Chinese yuan, RMB, 2.7%, up from 1.1% in 2016. Japanese yen, 5.4%. British pound, 4.8%. Other currencies, 6.6%. Gold, not in COFR but in reserves, increasing. The yuan's share tripled in less than a decade. That's the fastest reserve currency adoption in modern history. Historical precedent, British pound transition. The last time the world's reserve currency changed was the transition from British pound to US dollar. This wasn't a sudden collapse. It was a 30-year process from 1920 to 1950. The timeline, 1920s. Britain still dominant, but World War I, debts massive. US becoming largest creditor nation. 1931, Britain abandons gold standard during Great Depression. Confidence in pound shaken. 1944, Bretton Woods Conference. Dollar formally becomes anchor of international system backed by gold at 35 ounce. 1950s. Pound relegated to secondary status. Dollar fully dominant. The key factors that enabled the transition: economic shift. U.S. GDP surpassed Britain's military power. U.S. emerged from WTO as superpower institutional framework. Bretton Woods, IMF, World Bank created dollar-based system commodity backing. Initially gold-backed, then oil-backed deep financial markets. U.S. Treasury market became deepest, most liquid. For the dollar to lose reserve status, a similar set of conditions must emerge around a replacement currency. Can the yuan replace the dollar? This is the key question. Having 2.7% of reserves doesn't make you a reserve currency. The dollar has 58%. For the yuan to truly challenge the dollar, China would need requirement. 1. Capital account convertibility. The yuan is not freely convertible. China maintains strict capital controls. You can't freely move money in and out of China without government approval. Reserve currencies require full convertibility. Central banks need confidence they can buy and sell without restrictions. China has loosened controls gradually, but full convertibility risks capital flight and loss of monetary control. Beijing is unlikely to accept this trade-off soon. Requirement 2, deep financial markets. The U.S. Treasury market has $26 trillion in outstanding debt with daily trading volume of $600+ billion. It's the deepest, most liquid market on Earth. China's government bond market is growing, but still largely closed to foreigners and nowhere near U.S. liquidity levels. Requirement 3, rule of law and property. Rights reserve currency status requires trust that your assets won't be arbitrarily seized. The U.S. legal system, despite flaws, offers strong property rights protections. China's legal system is subordinate to the Communist Party. Property rights exist, but can be overridden for political reasons. See Jack Ma, Evergrande, recent tech crackdowns. Foreign central banks need certainty their reserves are safe. Requirement 4, willingness to run. Trade deficits. This is the paradox. To be a reserve currency, other countries must accumulate your currency, which means you must run trade deficits, send out more currency than you receive. China runs trade surpluses. They export more than they import. This accumulates foreign currency, not distributes yuan. The US runs deficits, which floods the world with dollars. This is necessary for reserve currency status, but politically painful domestically. China would need to fundamentally restructure its economy to replace the dollar. The realistic scenario: multipolar currency. System: given these constraints, the most likely outcome is entre yuan replaces dollar, but rather dollar shares dominance with multiple currencies. Think of it as going from monopoly system, dollar, determines 71% of reserves, to oligopoly system, dollar 45%, euro 25%, yuan 15%, others 15%. This is already happening. The dollar's 58% share is the lowest in 30 years, but still dominant. What does a multipolar currency world look like? For the United States, higher borrowing costs, less automatic demand for treasuries, lower trade deficits, tolerable, don't need to flood world with dollars, reduced ability to unilaterally impose sanctions, still significant but not monopolistic power. For other countries, more options for trade settlement, less vulnerability to US sanctions, more diversified reserve portfolios, regional currency blocks, yuan in Asia, euro in Europe, dollar in Americas. For global system, more fragmented, less efficient, multiple currency conversions, potentially more stable, not dependent on single country's policy, or potentially less stable, competing currency blocks and geopolitical tension. 4 scenarios. Scenario 1, slow managed decline. Dollar share falls gradually from 58% to 45% over 10-15 years. No crisis, multipolar system emerges. US adjusts, but remains largest economy and military power. Yuan grows to 12-15% of reserves. Euro stable at 22 to 25%. Gold increases. Probability, moderate to high. This is the soft landing version. Historical parallel, British pound transition, 1920-1950, but less dramatic. Scenario 2, dollar holds at 50-55%. Network effects and inertia prove stronger than expected. Despite BRICS efforts, dollar remains dominant because no single alternative has necessary scale. US financial markets remain unmatched. Military power backs currency trust, technology sector dominance, AI chips, maintains economic leadership. Probability, moderate, never bet against incumbency and network effects. Historical parallel, dollar post-1971, Nixon shock, survived losing gold backing. Scenario 3, crisis-driven rapid shift. Major geopolitical event, Taiwan war, Middle East conflict, or US fiscal crisis triggers rapid dollar sell-off. Central banks dump treasuries. Dollar falls to 35-40% of reserves in 3 to 5 years. Gold, yuan, euro, all gain. International trade severely disrupted during transition. Probability, low to moderate, requires major external shock. Historical parallel, 1931, pound collapse during Great Depression. Scenario 4, digital currency disruption. Central bank digital currencies, CBDCs, fundamentally change international payments. China's digital yuan, M-Bridge system, multi-CBDC platform, and other innovations allow instant cross-border settlement without correspondent banking. Dollar's payment network advantage disappears. Reserve currency concept becomes partly obsolete. Probability, low in next 5 years, moderate in 10-15 years. Technology advancing, but adoption slow. Historical parallel, no precedent, genuinely new development. What this means for you, if you hold US dollar assets, the dollar isn't collapsing tomorrow. The 58% reserve share is still dominant. US military, economic, and technological power remains formidable, but the trajectory is toward a less dominant dollar. Long term, this means potentially higher inflation, less foreign demand for dollars, higher interest rates, treasuries less attractive, stronger pressure for fiscal discipline. Diversification makes sense. Some international stocks, some gold, some real assets. If you're invested in international markets, emerging markets benefit from multipolar system. Less dollar dominance means less vulnerability to Fed policy and US sanctions. China, India, Brazil, ASEAN nations gain flexibility. For geopolitics, a multipolar currency system likely mirrors a multipolar geopolitical order. Less US unilateral power, more regional power centers. This can be more stable, distributed power, or less stable, competing blocks. Depends on how cooperatively nations manage the transition. The bottom line. The petrodollar system is eroding. The data is clear. 58% reserve share, down from 71%. Saudi oil sales in yuan. BRICS expansion to 36 nations, record central bank gold buying. But erosion is not collapse. The dollar remains dominant. No single alternative can replace it soon. The realistic outcome is a multipolar currency system, where the dollar shares reserve status with the euro, yuan, and possibly gold-backed or digital alternatives. This transition will take 10, 20 years, not 1 to 2 years. For Americans, this means the exorbitant privilege is gradually fading. The US can't run unlimited deficits forever. Fiscal discipline will matter more. For the world, this means more options, less dependence on US policy, but also more complexity and potential for currency conflicts. The petrodollar's final days? Not quite yet, but the beginning of the end? That's already here. Subscribe for ongoing analysis of currency markets, geopolitical shifts, and the evolving international monetary system. Thanks for watching.